I'm John Harding with the Harding Group, and today we've got my brother, Joe Harding, who's a CPA here in Phoenix, and we're going to be talking about a lot of things relating to tax and real estate. So we talk about things that you might encounter just with your personal property, the house that you live in, as well as if you're interested in short-term rentals, long-term rentals, what kind of benefits do you receive? Joe is a pro at this, and I'm not saying it just because he's my brother, though if that bias helps, it probably helps. Thanks for joining us. Take a listen.
Hi, my name is Joe Harding. I'm a CPA here in Phoenix, Arizona, and I have the privilege of being interviewed by my brother, John Harding, who has a real estate group. And so we were just, talking about real estate today and taxes, and went over, long-term, short-term rentals, and just had a good time talking about that. I'm in the middle of busy season right now, so it's kind of a good way to get out of the office. We're going to be creating more content like this to give you advice on real estate and taxation. I think it's going to be a good resource to have. So click on the subscribe button below. Tax law is going to be changing, so you really want to be paying attention to what we're talking about.
All right, Joe. So you've told me time and time again that real estate investing has some of the best tax strategy, the best implications for tax is if you're doing some sort of real estate investment. So I think for a lot of people, they're trying to figure out, okay, what does that mean for them? Does it even apply? Is there anything good for them? Is the getting good for your everyday average Joe?
For your average Joe, yeah. No, I would say yeah. If you got a plan for it, right? But real estate investments offer some. There's a lot of tax planning, a lot of flexibility there that you get out of real estate investing. Whether you're a W-2 wage earner or you own a business, I feel like it's like the one thing that everyone can save on taxes, obviously, as long as you plan for it right.
Okay. So whenever I'm talking to people, there's three ways that I see most people that are thinking about real estate investing. They're thinking about long-term, they're thinking about short-term, like an Airbnb, a VRBO. One thing that they're not necessarily thinking about, even though they're still renting, is their own property. So when it comes to investing in your own, personal property, what kind of tax benefits do you get from just owning your own house?
Yeah, there are some. You can possibly deduct some of the property taxes and mortgage interest, and that's about it. There are some tax credits for upgrading some of your appliances, like hot water heater, efficient air conditioning system. There are some tax credits there, but for the most part, you really are limited from a tax standpoint on your personal residence. You're limited right now. There's something called a SALT cap. So a lot of times you can only deduct out of your state income tax and all your state and local taxes $10,000.
Okay.
A lot of people are exceeding that SALT cap. Again, that may go away with the new tax law with 2026. It's kind of an interesting time right now because we're looking at the tax law. The Trump tax cuts are going to sunset this year. They're working on passing something, so they may get rid of that SALT cap. But the way it stands today, you're limited to $10,000 in your state and local taxes, and a lot of people go over that. They're limited there. You're also limited on your interest, your mortgage interest. You can only deduct up to $750,000 in principal. So anything over that gets limited. And so just from a straight, you're a W-2 wage earner, you don't have a business, anything like that. Those are really the three items: taxes, interest, and maybe some credits on some upgrades.
Okay. So what about somebody that operates a business out of their home or something like that? I know some people have some sort of home office. There's some sort of benefits there. What does that look like?
Yeah, the benefits aren't that great.
Okay.
I'm I'm not going to go into all the specifics, but there are some benefits. You can deduct some expenses against your really if you're working from home, you got a home business, or you've got a you do work out of an office, but you still want to have a home office. So at the end of the day, I guess if you're looking at tax strategy, I think having the home office does provide some other tax planning that maybe you're not thinking of directly to the home office. For one, your auto. So you've got a little bit more flexibility for deducting your auto expense if you have a home office.
Got it.
So let's just say you've got a location that you own, whatever it is. If you're leasing, or you actually own a commercial building, you want to have an administrative home office, and that way you get the benefit of the mileage from your home office to your office location.
Because you can't deduct a commute, right?
Yeah, because otherwise there's a commute. You're technically, according to the IRS, guidelines, you can't deduct that commute.
Okay.
That takes the commute away, especially if you're doing administrative work from your home office. So then now your business mileage starts at the home office, right? And then so then that leads to the whole vehicle. We won't go with all the vehicle stuff today, but there's a lot you can do there. So.
Okay. For someone that's renting right now, do you think it's a good idea for them to just buy their first property and take those tax benefits, whatever they are? Or would you say, just from a tax perspective, that they should get into some sort of other kind of rental arrangement with someone? What kind of benefits are they? And do you think that they're big enough to kind of offset?
Well, you can do this. You can do the same home office stuff with a rental as well.
Yeah.
Yeah, you can have a home office with a rental. That's not, now you're not going to have mortgage interest and all that, but you do have rental payments, and you could offset, you to basically take the square footage of the office, divide it by the total square footage of the house. And then that's where you get your deduction, and you can deduct things like the percentage of the rent. So let's just say 10% of the home you're renting is allocated to a home office. Well, now you can take 10% of the rental payments, utilities, and anything else like that, and deduct that, and then you still get the office. You still get the vehicle benefit as well. The idea of should I go and buy something? I mean, that's like really a personal finance question of can I afford it? Because you don't want to get into a house and then not be able to afford it.
Right.
That's just the worst, because when you go from renting to buying, now all of a sudden you got to repair. Now you don't call someone up to get something repaired.
You do.
Now you got a leaky roof.
That's right.
You got to, what is it? Is it about 5% or so the cost of the house per year in maintenance?
Yeah, how much you should be putting away, or
you should put away. So now you got expenses that maybe you haven't even thought about before. So I guess renting versus home ownership, that's another.
That's
a whole nother world right there.
Yeah. It's funny. I was just talking to a client this last week, and I said, you might complain about a maintenance person not coming there in the next 2 days or 24 hours or whatever the case may be. Otherwise, now you are the maintenance person, or you're going to call somebody and you're going to pay every single time you do something. So
and you got to figure out who to call, right? Electrician, plumber.
Yeah, and they're going to have a service charge, like
handyman, all that stuff.
Even just to come out and quote you. So it's just a whole different world that you should be prepared for. Yeah, it's not a small expense. Okay, so let's talk a little bit about somebody like you or I. We own our homes, and we're thinking about maybe getting a cabin. Maybe we're going up north a little bit more than we'd originally bargained for, and so maybe it just makes sense to buy something. Yeah. What would that look like from a tax perspective? What kind of benefits are available to someone that's using it mostly for personal use? And then what ways should they think about that property so that they can actually get some sort of tax advantage from it?
Yeah. Well, for one, don't buy a cabin in West Virginia, right? So.
Ding, ding, ding,
if you've seen Deliverance. Yeah. So I guess, we're here in Phoenix, Arizona. We like to beat the heat in the summer.
Yeah.
Owning a property up north, it's a decision. A lot of people end up buying one. They don't stay in it as often as they thought they were going to, because you get kind of bored. And so usually people come to me like, okay, what can I do with this cabin? I got a cabin, how can I make money off of it? How can I save taxes on it? That's usually how it works. A lot of people don't say, hey, I want to buy a cabin. Let's plan on the tax. No, it's like,
we already have it.
I'm going to be up there every weekend.
Yeah. And lo and behold, they spent 3 weeks.
Yeah. So, with that, you're probably, I guess, a cabin up north, you're probably not going to turn it into a long-term rental, especially if you want to stay in it yourself. But you're probably going to do some type of Airbnb or Verbo or whatever, some type of short-term rental. Now, they actually having something, I guess, even if you want a second home here in town, I guess looking at it that way, a short-term rental is much different than a long-term rental. In a long-term, the difference really between a short-term and a long-term is a short-term, your occupant is going to be staying there on average 7 days. Mm-hmm. So that's obviously very short-term. Usually when we think long-term, we think of a year or more. But even a month-to-month lease can be a long-term. It's considered long-term. Mm. So the tax situation is different. Even the way you report income when it's short-term, you're really considered like a hotel, and it's actually considered active income on the Schedule C, subject to self-employment tax, like a hotel would be. Right. Like you're running an actual bed and breakfast.
Which really. It basically is. I mean, you got to have cleaners out there every day. You can't let leaves pile up in your pool. You got to keep it pristine.
Yeah. Yeah. So with that, what kind of muddies all of that is your personal use of it. It kind of takes away some of the benefit, but let's just say, hey, I bought this cabin. I just want to turn it into a short-term rental. Mm-hmm. We're not going to stay in it. Let's just kind of keep it clean. There's a lot of tax benefit to that, potentially.
So tell me about that. I know you've talked a little bit about the cost segregation study with me. Yeah. When is that applicable? When is it not applicable? And what are some of the benefits that somebody should look into? When does it make sense to look into a cost segregation study? And why would you do it?
Yeah. So what a cost segregation study does is it, usually when you rent out a house, you split the land, the building, you depreciate the building over time. If it's a long-term rental, you depreciate that building. By default, everything is depreciated. Let's just have an example here. You buy $1 million house. Typically 20% is going to be allocated to the land, 80% to the building. So then you're going to allocate that $800,000 over, if it's a long-term rental, 27 and a half years. If it's a short-term rental, over 39 years, because it's really considered like commercial property. So a lot of people, they think, 39 years, that's a long time, right? Yeah. So the depreciation deduction every year, it's probably a lot smaller than you're thinking, especially if all of a sudden you buy this, $1 million house, 800,000 over 39 years. Right. It's going to be a while before before your expense there. So what a cost segregation study does is it takes, components of the property, the building itself, the landscaping, everything. You kind of have to, you don't want to do this yourself. You want to have it done professionally.
It's like a line item type of thing, right?
Like it splits everything out. So it's like roof, electrical, appliances. You kind of take a line out. You really break it down into components. It could be like 20 to 30 components of the home, and so there are some of those components stay at 39 years, and then others you can do like 15 years, and then 5 years. So the appliances, for instance, fans, and a lot of it's like landscaping too. You can all of a sudden, rather than depreciate over 39 years, you depreciate them over 15 or 5 or 7.
And it sounds like it's based on the life of that particular item in the house. So if it's an appliance, it's probably a lot shorter than if it's.
Yeah.
Okay.
Now the AC is still at 39, but yeah. I don't know of an AC unit that lasts 39 years.
Yeah, I'm going to tell my clients next time. I'm going to say, hey, this thing's basically brand new. It's only 10 years old. You get another 29 years on it.
But so the benefit is now that with the way the Trump tax cuts have been phasing out, one of the things is bonus depreciation. So bonus depreciation back early, like 18, 19, 20, you could take those 15 and 7-year components and depreciate them 100% in the year that you put it into business. So rather than wait 39 years, it's going to depend on the property, but the savings were pretty substantial. I mean, I got a couple of, I had a client that had like a $2 million building. We did a cost segregation study. He was able to bonus $700,000. For an Airbnb, you can take that and let's just say on a $400,000 house, I think it's between like $160,000 or so. Now you got this $160,000 bonus depreciation. Now you've on your first year, you're going to have a huge loss on that property. Mm-hmm. So the planning comes in as, okay, how do you deduct that? How do you get that loss against your other income, especially if you're making, $400,000 or $500,000? Let's just say you're a W-2.
Right.
There aren't a lot of things you can do as a W-2 wage earner to save on taxes.
Yeah.
You're really limited. But if you do it right, you can actually save against your W-2 wages. So you can take a $160,000 loss against your other W-2 wages.
With owning this property.
With owning, as a, really as a short, it's typically going to be as a short-term rental. Now there are some rules around it, and they get kind of funky. There's something called material participation that you have to have in it. So you can't just buy this and then somebody's managing it, taking care of it. You actually have to put some work into it yourself in order to get that benefit.
Okay.
The rules are a little weird, but one of the general rules, is that you got to put 100 hours into this thing
over the course of a year.
Over the course of the year, okay. You got to put 100 hours into it, and it's got to be more than anyone else has put. And you got to prove that you put more than anyone else. So, if planned for properly, that's one way right there of. You're a W-2 wage earner. You got a house. You buy a short-term property. Mm-hmm. That's how you get that. That's how you get that big benefit there.
I could see that, especially coming into play if you get like a husband and wife team. The husband is a W-2 wage earner or something like that, and the wife begins to manage Airbnbs for you as a family.
Yeah,
I could see that being a pretty good strategy because you've got it right because they're filing jointly. Yeah, the wife's going to be a part of that material participation. I feel like the material cooperation with evil is what we're talking about.
Material cooperation. What's that about?
It's like doctrine, right? Oh. It's like that's a Catholic doctrine. Oh. It's material cooperation with evil. Sorry.
Oh, yeah. Okay. I did not know that.
Oh, well.
That's for another podcast.
That is for another podcast. Yeah. That's for sure. So, okay.
Well, I actually had that recently. A couple, but really it was the wife who was like, they bought this home here in Arcadia and they weren't sure before they came to me, they're about to turn it into a long-term rental. They're about to rent it out. And I said, well, I got to understand what they want to do with this property, right? Because when we talk about tax savings, this let's just call it $160,000 deduction. It's not necessarily tax savings. It's tax deferral. Mm-hmm. You're basically kicking that can down the road.
Right. It's like a 401k.
If you sell that house and you don't plan for it properly, you're going to have to pay tax in the future on that, what's called depreciation recapture.
Got it.
So you basically, rather than pay the tax today, you're going to pay that tax later on down the road.
What if you occupied that property in the future and transitioned it from a hotel to a personal residence?
Yeah. You just lose though. You don't have to recapture it in the future.
If you transition.
If you transition it to your personal
That's
house,
beautiful.
you do not have to recapture that. It's if you sell it, you dispose of it. And so that's going to stick, that depreciation amount is going to stick with a house over time.
Mm-hmm.
And so that's when you have to plan. Let's just say, hey, for this couple, this is their dream house.
Mm-hmm.
They plan on retiring in this house. So they came to me, they said, we don't know what to do with it. And what we determined together. And that's really, it's a decision you want to make with a professional.
Yeah.
And that you've kind of looked at it from various angles. For them, it made sense to, hey, turn this thing into a short-term rental.
Yep.
Offset your other income. They're making almost $1 million.
Yeah.
And now, they're going to save this year, they're going to save $100,000 in taxes, just in the tax alone. And they can kick that thing down the road, indefinitely, especially if they plan on, retiring and living it for the rest of their lives. Now, if something happens in the future and they need to move, we can work with that too. But, hopefully they're still using me. And I think they will. They're really happy because they were about to turn it into a long-term rental. And
which you won't get any of the.
And you're not going to get some of these. Well, you can, but they didn't fit that mold.
Okay.
There's something called real estate professional status,
and they are not
that comes into play. And then they didn't have it. They didn't fit that requirement. They didn't fit those criterion to do it right. So what made sense for them is to do the short-term rental.
Okay.
Of course, that's kind of scary, right? All of a sudden, to do a short-term rental, you've never rented out anything in your life.
Yeah.
And in fact, the first
learning
day
curve is
like one of their first guests, they learned early on, like this guy was like he pretended to have a family and didn't have a picture and didn't have much history. And all of a sudden they get a Ring camera.
Yeah.
And all of a sudden they see this like scantily dressed woman pressing the doorbell. She's dressed like a prostitute, basically.
Oh my goodness.
So come to find out, they're having some big party. She was probably a prostitute. Yeah. Anyways, and this is the middle of a very nice Arcadia neighborhood.
Yeah.
So they learned early on.
What the neighbors signed up for.
So, yeah, exactly. They, all of a sudden, they ended up showing up to the house that night. They show up to the house and
because they see it
and kick everyone out.
Forget this.
You imagine how scary that is?
It's a scary thing to do.
Like, yeah, who knows who these people are?
We can pack here and.
Yeah. In Arizona, it's like, you don't want to, you never know, but that, fortunately for them, it wasn't enough to scare them away from it. They learned their lesson,
of course. Yeah.
And now they're just enjoying it. They put a lot of time, mm-hmm. she put a lot of time into this property, just furnishing it, getting it right.
Yeah.
And then, there's a lot of work. See, that's something you have to consider, right? It's all this stuff you put into it. And then now you got to manage it. And a lot of times you got to manage it yourself because nobody's going to manage your property as good as you.
Yeah. Which is something that I've seen from a property management perspective. One, there are not many long-term property management companies that will do short-term because they know it's so difficult and it's so demanding. The only people that I've seen do well is someone that already has, maybe they're already working for a family that has 4 or 5 rentals, and then they pick you up as a second client or something like that. They can do a great job. Typically, they also need to be incentivized properly. So it's got to be based on reviews, occupancy, all those things.
Yeah, you got to answer the questions right away on the app. Otherwise, no one's going to stay in your property.
That's right. Yeah, and your reviews are so critical too. Yeah. I think some people get into the short-term game because they've done long-term, and now they say, okay, well, I've got this great property. Let's see if I can make more money from it. And they're just two different games. Yeah. One is, this is in a decent location because it's near employment center or something like that. And so I'm getting people to rent it all the time. I never have an issue renting this property. maybe the bedrooms are big and the closets are big, and everything's right about it. Doesn't have a pool, doesn't sleep a lot of people, but you think, oh, let's transition it maybe for tax benefit or whatever.
Yeah.
And then you put it up online. You don't know marketing. You've used Craigslist or whatever to fill this thing, or Zillow to fill that property. And what makes a good long-term rental is not even close to the same thing as what makes a good short-term rental. I've seen that happen a number of times where people feel overly confident. They jump into the game and find out they're woefully unprepared.
Yeah. And people, people adjust. You just gotta know you failed this one time, just kind of learn from your failures and just try to do as best as you can. And really, to get those reviews. And so and that's what they did. And now they have all sorts of great. I mean, their Airbnb's booked for like the next couple of months now.
Yeah.
So
increase.
And they were just like so happy that they did it. Yeah, they're so happy that we planned for this and that they did the Airbnb property. Now, obviously, not everyone's going to be like that, but that was for me. It just felt nice to be able to kind of guide them through that situation.
Right.
They're going to save $100,000 in taxes,
and they're going to make money.
And they're probably, now, what can you do with $100,000? So now they're wondering about the next property to purchase.
Right? Oh, is that right?
So,
yeah.
Well, because you got $100,000 extra that it's not going to Uncle Sam.
Right. And you can turn that into another property and do it all over again.
Yeah.
Or maybe switch strategies and do a long-term rental. And
year after year. I was talking about earlier about the tax cuts kind of sunsetting. Well, one of the things on the agenda, from what I understand, is 100% bonus depreciation coming back into play next year, 2026. Right now, it got phased down to 40%. So kind of what I was talking about before. Let's just say you broke up the property, the cost segregation, you broke it up. $200,000 or the 550, basically less than 20 years. Now you could only take an $80,000 deduction this year, whereas in the past you could take $200,000.
Oh,
so the benefit comes kind of dwindling. I mean, it's still a good benefit. I mean, if you're gonna buy a property, you're gonna do that, and if everything makes sense, do it. But obviously, kind of nice to to be able to deduct $120,000 more in a year. So those opportunities, I can foresee them coming back again. Come 2026. So
right. If the taxes.
We'll learn here in a couple months or so.
Yeah.
That's a whole political process, but those are the things being floated right now. So
yeah. So that's a lot about short-term rentals. Anything else on short-term rentals that people should be aware of when it comes to, all right, how can I maximize my tax situation?
Yeah, you don't want to stay in it as much. You don't want to stay in it that often. When you're in that year you're doing the cost segregation.
Okay.
Yeah. Kind of want to make sure it's everything's kosher. It's
doing what it's doing.
It's you're treating it like a business.
Yeah. Okay. Let's transition a little bit to the long-term rental situation. So if someone is doing long-term rentals, what are some of the benefits that they can see from going that route?
Yeah. So if you do the cost segregation study and you incur a loss, a lot of time your income typically, for most people, their other income usually ends up phasing them out of being able to deduct that loss. So let's just say in an example, $160,000 deduction first year.
Mm-hmm.
And let's just say, just for an example's sake, that depreciation creates $160,000 loss for the long-term rental. Well, you can't use it. It ends up going into the future as what's called a passive activity loss. And so for the long-term renter, I mean, it's all depending on how you're going to structure all this. You just don't get the same benefit unless you've got the real estate professional status, and that doesn't necessarily. And I think a lot of people think, well, do I have to be a realtor to be that? And you don't.
Sure.
In fact, you can work in construction for your normal job and be a real estate professional. So it depends on it depends on what you actually do for a living.
Okay.
It has to be 750 hours at least in real estate activities.
Mm-hmm.
And it has to be a majority of what you do.
So is it just things that are ancillary to real estate? Like what are some of those things? So construction,
construction,
like interior design.
Interior design. is another one. I don't have a full list right now, but those are some examples you can kind of figure out what, unfortunately, I don't think lending gets you there.
Is that right?
Yeah, real estate lending doesn't get you there.
That's so sad.
Yeah.
I know a good lender, and his wife is a real estate professional, and so I'm sure that's how they're working things out. Is that's her primary occupation outside of being a mom.
Yeah. So I guess if it can work for some people. So if let's just say you don't. Let's just say someone's working in construction, they buy a long-term rental.
Yep.
They also have to have material participation in that activity. And that was the threshold for the short-term rentals, that you had to have material participation. For long-term, you got to have material participation and real estate professional status to take advantage of those losses. So it's kind of like a two-prong test. A lot of times, if you can't get that, because it's kind of hard to get 100 hours in the future, year after year. One of the ways is you can actually group, if you've got multiple rental properties, you can actually group them. So you can group your activity to be material. You can, let's just say you got 50 here and 50 in another property. Well, you can actually combine those activities.
So it doesn't have to be specifically devoted to the property itself. It just has to be activity
in that
realm.
Yeah. You can actually bundle all of your residential real estate activities into one activity. It's like on your tax return. You gotta make that election.
Okay.
It gets a little complicated when you actually dispose of one of those properties, because then all of a sudden now
where did that time go?
You lose that grouping, whereas before, it's
so you'd have to regroup.
Well, yeah, pretty much.
Yeah.
You gotta go back to the drawing board, regroup, and
we lost a property.
Yeah, we lost it. Yeah.
It was a good one.
All to say is, like, you got to plan. You got to plan for this stuff, and you definitely you want to work with a CPA that knows this stuff very well. So
yeah, it sounds complicated. It sounds like there's combinations.
Yeah,
and I don't want to think about it.
And there's it's like rules. It's like playing any game. I played a game Dune, and I almost lost my mind. There's a game Dune. You know the movie Dune?
Yeah.
There's a game.
I didn't know.
And I'd never seen the game. I've never seen the movie Dune.
Yeah.
So try to understand all the names.
For it. Yeah.
Like, I'm not sure if I'm saying it right. Like the Bene Gesserit and all that. Like, that doesn't mean anything to me.
Right.
And like spice.
I know spice in Star Wars is like,
I know,
but
all I'm thinking of spice is like curry or something,
Had some of that last night, actually.
And I'm trying to play this board game with Dune. And then I watch the movies like, now the board game makes understand. It makes sense.
It makes sense, yeah.
That's kind of how it is with all this
huge.
stuff. You just have to, just make sure you've got a guide, and then that's gonna, walk you through right. And not someone who's like, well, I don't know. Yeah. You gotta have somebody who's done this with their clients before.
Right.
Yeah.
It is very true. Anytime, the guy that's leading you should not be. It should not be his first time.
Yeah.
Or
TikTok, there's a lot of TikTok videos on a lot of these strategies. And I get a lot of questions from people because they saw something on TikTok.
Oh, yeah.
Which makes me want to do these podcasts, because I was like, crap, man, if these guys are watching TikTok, I got to do this stuff myself.
Well, not only that, I saw this ridiculous video. I immediately thought of you.
Thanks.
The guy, not because you're ridiculous, but what he said was ridiculous. So he said, if you're providing these ideas to your accountant and your accountant is shooting these ideas down, you need to get a new accountant. And I was like, you're an idiot. Like, if that accountant knows what they're talking about and they've got your best interest at heart and they're planning with you year over year and they're shooting ideas down, it's probably because it was a dumb idea provided by a TikToker.
Yeah. Well, there are some CPAs though that you kind of feel like, who are you working for?
Yes,
are you working for the IRS or me? I get that all the time. So you get some people who, because they're just so CPAs tend to be risk averse.
Right.
And so they don't want to go out there and give you advice that it could kind of, it's a little, on the gray side. They kind of see things black and white.
Right.
And this is the way it has to be. And so, they're going to shoot your ideas down because, well, first of all, they may never have heard of it, or they're just like, oh, that's really risky. You shouldn't do that.
Right. Which, of course, nobody wants to hear that.
Talking about.
Yeah.
Yeah.
And of course, I saw it on a quick stream, so
exactly.
I didn't see the whole context for it.
Sure.
But as I think about that, I think, man, there are. Well, I know some of your clients have come to you and they've said, especially during COVID, I remember them coming and saying, "Hey, my accountant didn't even know about these tax credits that are available, like the employee tax credits. They didn't know about the PPP stuff."
Yeah.
And they came to you and you were ahead of the game. You were like on top of it and helping them get stuff filed well before these huge employee tax credit mills came about and all that.
Yeah.
Like, you're pretty cutting edge. How do you stay on top of these things?
You just have to be really good.
What a cop out.
I mean, you have to. I mean, it's a lot of this stuff starts in legislation.
Yep.
And then you gotta have to just read read articles, attend webcasts, and just try to stay on top of it as much as you can, because it can get pretty overwhelming, especially around COVID. That was so overwhelming. I felt like
It was changing like every day.
the news changed hourly.
Yeah.
And you got these stimulus bills that came out, and it's like, what are in these?
Yeah.
They're no one can read them.
Pages. Yeah.
This is before Chat GPT. You couldn't just throw it into there and it's like, what does this say?
What is this?
Which is so we'll see. Yeah. So like right now, like is going to be a time for me to sit down and figure out what's going to happen next year. So that's kind of what that's the nature of the beast, is that, try to stay on top of it. You're never going to be able to stay on top of everything. And that's why, I limit my my niche to really like real estate investors and business owners.
Yeah.
I'm not my clients are, I've got some startup clients all the way up to like, 20 plus million in revenue. That's kind of the range of my clientele.
Yeah.
And then, but kind of like we were saying before, I realized a lot of the tax strategy that I had, or that I could provide that was really meaningful to my clients was real estate, because they want to own real estate. Everybody wants to own real estate. We're in Arizona.
Yeah.
If you're not owning real estate, you kind of feel like you're left out, especially, you're golfing with a buddy and they're talking about their real estate holdings and all that.
That's right.
So I help my clients, obtain real, I've got one client, he'll call me up and he's like, "Hey, I can buy the building I'm renting out. I don't know, should I do it?" And we realized, yeah. And so that's the one where, we got, the cost segregation,
right,
$600,000 deduction. He did it right, and everything. And so he just didn't even register in his mind, because, they're so busy doing what they do best in their business. They're not thinking about they're not thinking about, what is this real estate? How can this benefit me? And for him, it was he got it at a good price, got some tax savings. And then now he, his office runs out of it, and he doesn't have to, he doesn't have a landlord now. He's got that freedom.
Yeah.
So
he's painting the place whatever color he wants.
Whatever color, man.
Putting in that wild tile.
Yeah.
So obviously there's a lot in the commercial space then too. How much are you playing in the commercial space to help people get tax savings there as well?
Yeah. Because the commercial space is, you have to work with these real estate professional designations. But if the company leases from the real estate they own, it's almost a slam dunk. Like
you buy the property,
opportunity there,
then you lease from yourself.
But you can take advantage of the cost segregation study without being a real estate professional. I'm not going to go into all the specifics, but yeah, if you're running your company and you go buy a building, like you need a plan for that,
right?
And you can get that benefit of that cost segregation study and offset the losses against your business income, right? So,
and then hold a commercial property that you could sell off in the future.
Yeah, or if you sell or 1031 it and do something else, that's that's kind of where, like what I was saying before, like a lot of this is tax deferral.
Yeah,
you can get hit with a tax bill later on, and if you don't plan for it right. So that has to be in your plan. Like, hey, like this is going to be a long-term strategy, and real estate is going to be a part of my portfolio.
Right.
and I'm going to build my real estate holdings over time. If you're thinking about just doing this 1 year and then selling it later on, that's not good planning.
Right.
Unless it makes sense. But for most people, if it's just like, okay, we're just going to, if you're thinking that, hey, we're going to save tax, and then
That's the only reason.
That's the only reason why I'm doing it. It's not a good. That's usually not a good strategy.
Right. It's funny that you bring up the 1031. Obviously, there's some people that really, really specialize in 1031.
Yeah.
It's funny to me. A lot of people don't realize that real estate for real estate is the rule. So you could go from commercial to residential. You could sell that commercial property. You could buy 4 residential properties if you really wanted to.
Yeah.
That like for like is.
Yeah.
It's just
You want to
holdings.
use someone who does 1031s, and that usually it's like a title company is going to put that, property in the trust and all that, and make sure that you abide by all the rules. But yeah, so that's just one example of how, of how you want to plan.
Yeah.
Especially if, hey, like I've got another property here I want to buy. I want to sell this one, buy that one. It's like, yeah, don't just sell that one and then buy the other one.
Right.
Because you can't go back and if
you can't do it.
You can't go sell it. Once you sold it and you didn't plan for it, you're done.
Yeah, that's right. If you didn't declare, if you didn't work with a 1031 professional to get it all figured out, it doesn't happen.
Yeah.
And then you got to find property quickly, and you got to abide by all the rules.
Yeah.
What about capital gains? So I know we talked a little bit about the personal property, not personal property, but real property that you're just holding personally. What are some of the capital gains implications there? And what are some of the other capital gains things that people need to be concerned about when it comes to selling off a property that is being rented?
Yeah. So if you just sell it off, you've got that depreciation recapture. So however you're actually really required to depreciate a property over time. So even if you let's just say your accountant didn't, or you did use TurboTax, you didn't depreciate your property. The IRS could say you should have depreciated your property. Now you got a bill. Let's just say $100,000 is accumulated over time. Now you're gonna have to declare income on $100,000, even though you never got that benefit over time. So depreciation recapture is one thing that's usually the big surprise. And then you've got long-term capital gains tax. Usually that's more relevant. So depending on your income, that could be federal from 15 to 20, and then there's like some Medicare surtaxes and all that. But let's just say it's going to be between overall you're from a federal, it's going to be probably between like 15 to 22% on the capital gain part. So
yeah, it's steep. It can be steep.
Yeah.
The other thing that I think most people don't realize is that sometimes you just have to stay in that property. You just have to stay in it. What is it? 2 out of the 5 years.
You're talking about your personal. Oh, okay.
Yeah. I mean, transitioning a long-term rental or even a short-term rental into a personal property and then selling that property, as long as you're staying with it, I can't remember off the top of my head.
Yeah, you stay out of it 2 out of 5 years. There's some weird exceptions to that, but let's just stay by the 2 out of 5 years.
Sure.
So if you're single, you lived in a property 2 out of the last 5 years, you could exclude $250,000 capital gains. And if you're married, $500,000. Now both of you and your spouse had to live in that house. You both have to meet that requirement. You can't just be single, get married, and then get the $500,000.
Sure.
You both have to live in that house for that period of time. The one thing that people don't realize is that depreciation recapture is not under that capital gain exclusion.
So you still
have to pay tax on that $100,000. Like in that example, $100,000. Let's just say you had $500,000 capital gain, and then $100,000 depreciation, accumulated depreciation in that house. That does not wipe away the accumulated depreciation. There's another thing too. If you are planning on doing that, the best way to do it is to live in your house first,
okay,
and then turn it into a rental property and then sell it. I'm not going to go through the rules; they're a little confusing. But I did this with a client.
Yep,
and we looked at. Yeah, I looked at the rules because you're really limited on the capital gain exclusion if you rent it first and then live in it, even down the road. you could live in it for 10 years and you still don't get the full 500,000. So it's a little weird that the way the rules were written, it's just, it is what it is. So I just, if you're going to do it, live in it first, and then rent it out for 3 years, live in it for 2, rent it out for 3, sell it on 5, sell on year 5.
Yeah. Okay.
You're still going to have some depreciation recapture there, but you'll be able to take advantage of that exclusion. You still get the exclusion, 100% of it. So.
Okay. Yeah, that's awesome information. I did not know that.
Yeah.
Well, obviously there's a lot that I did not know before we started this conversation, but really appreciate you breaking down a lot. And if you have any other nuggets that you want to share before we close this bad boy out, I think you covered quite a bit.
Yeah. Yeah. Again, like don't buy that home in West Virginia.
Yeah. That's a big takeaway. Huge takeaway.
There's actually a lot of heat right now that the people who live in that town, I'm forgetting what the town is called. They're all like bent out of shape because it's got this stigma.
Oh yeah.
Yeah.
Maybe just rename it.
Yeah. Yeah. Exactly. Yeah. Don't watch the movie.
Yeah. Yeah. If you've not watched the movie, don't.
Yeah.
It's a terrible movie. Yeah.
Yeah. Any other nuggets of wisdom? Kind of feel like Kamala. Nothing comes to mind.
Jeez. Nothing.
No, I mean, I think what I said. Yeah, exactly.
Nothing.
No, I think what I said, like a lot of this
difference between.
I know you probably hear it all the time. Like, there's no one size fits all solution. Like, you really have to plan for this,
right?
And you have to work with a CPA that's willing to work with you. You know, you don't want someone who's going to bend, get you in trouble.
Yeah.
Someone who understands the rules, that's not going to get you in trouble, that can help you, talk through all this. And at the end, maybe hug it out. So
that's a good point. If you can't find someone to hug it out with, then maybe you find a different CPA. All right, well, that's a wrap.
Probably smell like mothballs too.
Yeah, that's terrible and true. Sometimes the worst jokes are mostly true.
Yeah.
Thanks for joining us, Joe.
Thank you for having me, John.
Brothers
forever.